The next objective introduces us to this term contribution margin and contribution margin ratio. So we're going to begin to look at the income statement from the lens of a manager instead of an outside third party such as a creditor or a stakeholder. So as we begin to go through this section, keep in mind that this is the managerial section, and we want to know what managers can do to make sure that they are operating as efficiently as possible within their organizations. So contribution margin is one of the methods that we use to do this. So if you remember our traditional income statement that we've talked about in financial accounting and in the first section, we basically focused on sales, we subtracted cost of goods sold, and we came down to gross profit. So when we're talking about product cost, the cost of manufacturing our product, can we sell our product, our inventory, for a profit? And that's what the gross profit tool here measured. And then we backed out those operating expenses, or what your book calls here the period cost, those administrative costs that are taking place in order to sell our product, to come down to operating income. So now with operating income, we can look at how efficient are we as a company as a whole in not only selling our inventory, but the daily, periodic, and ongoing operating expenses of the organization. So the contribution margin income statement, okay, we still have operating income. Okay, in the end, this is what we're looking at, but from a different perspective. So here we're going to look at sales less variable cost. So we begin with sales just like before, but we're going to break these cost of goods sold that we see here. We're going to break them down into variable cost and fixed cost. Okay, so sales less variable cost. Regardless of whether those costs are product or period, we just want to know variable cost. So out of our cost of goods sold, we have some that are variable, we have some that are fixed. Out of our operating expenses, we have some that are variable and we have some that are fixed. So what we're looking at is sales less variable cost equals contribution margin. And it's called contribution margin simply because this is what we have to contribute to or to cover our fixed cost. And then contribution margin less fixed cost equals operating income. And this is important to us because if you'll remember, as sales increase, then we're going to be, if sales are increasing for volume, then we're selling more product, which is going to generate more variable costs, which will generate more contribution margin. And once all of our fixed costs are covered, this contribution margin actually becomes the profit for the organization. Okay, so as your book tells you, the primary difference between the sales revenue or the primary difference between sales revenue and variable cost is what generates contribution margin. And we're trying to identify how much cost do we have to cover these fixed costs that are taking place in our organization. So once again, what can we do to control costs? Fixed costs are normally fixed. Variable costs we have some control over. We need to be able to identify those. And we can express contribution margin. You may hear it sometimes called, in this particular example, it may be called unit contribution margin. Or, okay, I'm more likely to hear it called contribution margin per unit. And that simply is sales. What are our sales per unit? Less variable cost per unit equals our contribution margin per unit. Okay, and this is going to be key. We have to understand this to move forward, to begin to calculate break even for our company, to begin to predict how many units we need to sell to generate a certain amount of gross profit. So once again, we need to know that sales less variable cost is contribution margin. We can calculate that in total, or we can calculate, sales per unit less variable cost per unit to come up with a contribution margin per unit. Both numbers are going to be important as we move forward in total and as a whole. We're also going to use contribution margin ratio in some of the formulas that are about to show up in the next objective. And contribution margin ratio is very similar to your gross profit margin ratio. It simply takes our contribution margin that we had from our prior slide of $45,000, divides it by net income. Let's go divide that by net income to come up with our contribution margin percentage. Once again, we can do it in total or we can do it per unit. Okay? So here's a comparison, a visual of that traditional income statement and the contribution margin income statement. Just like I showed you in the prior slide, sales less cost of goods sold equals gross profit, less those operating expenses, selling and administrative expenses, to come down to operating income. Okay, so in these cost of goods sold, like I mentioned, some of these costs are variable and some of these costs are fixed. Okay, we need to be able to separate them to be able to control cost and estimate future profitability of our organization in the same way. And these selling and administrative expenses, some of them are variable cost. Okay, but also some of them are going to be fixed cost. In the end, we're still coming down to operating income. Simply, this is what an external person really wants to know about our organization, but internally, in order to make wise decisions about efficiency and profitability, we need to be able to separate those variable costs from the fixed cost. Going back to, as I mentioned, okay, if sales are increasing, okay, then contribution margin is going to be increasing. But as sales increase, fixed costs stay the same. The fixed cost in total do not change as a result of volume. So if we can increase contribution margin, we can increase net income once fixed costs are covered. Okay, so keep that in mind as we move through. Take a minute, take some notes, and we'll come back and look at how we can use contribution margin to actually calculate some cost volume profit analysis for our organization.